Hello, everyone. Let's get started. On behalf of Haynes and Boone, Aegis Energy Risk, and EnerCom, welcome to Season 3, Episode 6 of the Energy Tracker. This episode is a special edition of the Energy Tracker as we are live from EnerCom. So special thanks to our host this morning. Haynes and Boone has been a longtime supporter of EnerCom, and in fact, I think it was a Haynes and Boone lawyer, Alan Telesnik, who was there at the creation of EnerCom 25 years ago. My name is Jeff Nichols. I'm a partner in the Houston office of Haynes and Boone, and I'm co-chair of the Energy Practice Group. I'll be the moderator of today's call. The series is broadcast live on Tuesday mornings at 9 a.m. Central. This call is being recorded on August 18th, 2020, and will be available for replay by EnerCom at oilandgas360.com and by Haynes and Boone on our podcast called On Track. If you're listening to a replay of this and would like to attend the live calls or would like to send questions or suggestions, please email me at jeff.nichols@haynesboone.com. As always, email Craig Grauman with any complaints. One quick announcement. After September 1st, our calls will switch to the first Tuesday of every month. If you subscribe to the current calendar invitation, you will receive an update. If you would like to subscribe to the current calendar invitation, please email me at jeff.nichols@haynesboone.com. Our speakers are shown on the next slide. First, Aaron Vanderford from EnerCom will discuss business issues for E&P companies. Then Matt Marshall from Aegis will discuss pricing and markets with extra insight this week on a variety of hedging topics. Then I will highlight our latest Bankruptcy Reporter and turn it over to the oil and gas bankruptcy sluggers, Charlie Beckham and Eli Columbus, who will give us the inside baseball discussion of what's happening to these E&P companies and more and more are filing bankruptcy and as they wind their way through the system. Finally, special thanks to Liz Felicidario and Rima Abdurazek for running the technology for today's call. So now I'll turn it over to Matt. Take it away, Matt.
Thank you, Jeff. Well, I don't know if you noticed, but the prices have been a little volatile this year, and we have seen some changing attitudes toward hedging and how to approach hedge strategies. So I thought we could talk a little bit about that in some detail because I think we have some insight that generally isn't available in the markets. First, let's just look at where prices are because I want to be able to get some context behind this. So, prices these are through yesterday afternoon, and you can see that prices have been recovering slowly. I'm trying to get my head to work here. They've been recovering slowly, but the prop month was just under $40 in June, and now it's just over $40. But there's some good signs here. Cal 21 is getting close to $45, and that opens up some possibilities for hedging that we'll talk about in just a few minutes. But there's a threat here. It's what if prices stay near this range through 2021? If that $44 or $45 through 2021 is realistic. So here's a big reason why it might, and this is the only fundamentals, that is the supply and demand slide that I'll show. And then this is incomplete analysis, but it just demonstrates the weakness that we're facing right now. So OPEC has the capacity to produce 31, 32 million barrels a day, and that's somewhere around 6 million of capacity that they can bring to bear, because right now in August they're probably producing about 25, so they could increase by about 6 million barrels a day. And then on the demand side of the balance, this figure is from EIA's latest forecast right here. It's total global demand for petroleum. Not that they're the best forecaster out there, but right now the globe would be around 95 million barrels a day of demand, and by the end of next year demand would be 101. So that's a growth right now of about 6 million barrels a day. So there's a possibility that between now and the end of supply could match demand barrel for barrel. Now, like I said, this isn't complete. It doesn't mention non-OPEC production, doesn't mention the amount of oil currently in storage around the globe. So for the rest of the time, I'd like to share what we've been seeing among Aegis clients, how their attitudes toward hedging oil prices are changing. And among our E&P clients, their total production is about 3 million BOE per day. It doesn't include any super majors. It's fairly split between oil and gas. So it's a good sample of U.S. activity. It includes large independents, small private companies, lots of private equity-backed minerals or otherwise non-operated, everything. And so we see how hedge patterns change in real time, and we have insight into these hedging trends that really isn't known to the market at large. So what are some of the themes that have emerged since March? First, private equity clients. We've seen some increased involvement by sponsors asking for more concrete hedging plans, more involved in the process. And then no matter what the type of organization, generally we've seen a change in price targeting. In 2019, the phrase we may have heard was, hey, let's hold out for $58. And now it's, I can live with 43. And there's a general understanding that this market is still uncertain and it's more attractive to take current pricing than rather risk oil in the 30s again. We're seeing more certainty in hedge effectiveness. Some who maybe have used three-way collars in the past where you don't have complete downside protection are abandoning that practice and using more vanilla collars or swaps. In general, those who had targeted a lower percentage of their production to hedge are increasing that percentage of their production to hedge, at least their PDP. And similar to private equity sponsors, we're seeing more requirements from boards of directors to have an established hedge program. That doesn't mean that the boards are requiring an overly mechanical or rigid program, but they're asking for better planning. And even though prices are low right now, we've seen some activity in longer dated tenors, hedging farther out in time, farther out the curve. Doing so incurs some slippage. Lower liquidity affects the price you receive. The most important or most interesting development that I've seen has been among firms who previously tried to avoid hedging altogether or just did the minimum. Some that this is surprising me. Some well-known names are asking how to install a hedging program that protect them because they felt some pain. So of course that's what we do is we design and execute hedge programs. And we don't need to read all the text on this slide. Use it as a guide later if it's useful. But at first, you just have to ask yourself, like, these are the components. Like, you have all the information and data you need to be able to make hedge decisions, trading decisions. At least do you have gathered in one place your future production estimates, or what your bank requires, what your own policy is, and how many hedges you actually have on the book so that you know how many hedges you can have. Then you need to have some technology. The valuation system itself can be really expensive, but do you also have a way to quickly gather bids from all your counterparties that you plan to use? And then when it's time to make a decision, are you ready with what your price targets are? What price you're trying to reach, and can you get it done quickly? The opportunities in hedging sometimes happen on the weekends. Our largest volume days have been on Sundays. And then you can't forget about cybersecurity and keeping data in the right hands and only the right hands. So we group these hedging activities as research, trade, and manage. And you'll continue to see more technology and services from us categories. Some EMPs need more help in one area than another. But if you're trying to figure out what changes you should make or how to get better outcomes with your hedging portfolio, you can help. So as I mentioned, $45 might be the reality for the next couple of years. Some EMPs have become more price takers than price optimizers recently. And I think this diagram explains why. I mean, you can't return money to your investors if you can't pay your lenders, and other financial goals sit in between. So last year, many of our clients were in the top of this pyramid. I mean, oil was flirting with $60, demand was strong, and in the second quarter of this year, many slipped into the bottom where they're making changes to the basics. It's hard to fight $20 oil or worse. But now we're seeing clients kind of climbing their way back up. And then the next slide, it shows you a really positive development for hedging opportunity. So what we have here is that prices have been rising modestly in the last 3 months, but they have risen past some key thresholds for many of our clients' financials. And this chart is from the Aegis trading team as of yesterday afternoon. These are good estimates of the actual costless collars our clients have been able to. So the floor or the put is down here on the bottom, and the cap or the sold call as part of the costless collar is along the side. So this top line right here, this theoretical bid, that's the business school calculation of what the collar should look like if you use a computational method combined with the actual transactions observed in the market or the bid ask. But as a producer, you always get a discount because of the bid ask spread at small margins, and that's what's at the bottom here. But right now, there's some really good choices. For example, a collar with protection of $37.50 on the bottom also lets you participate in prices if they rise up to $51.35. And similarly, you could get protection if you were to you let protection go down a little farther to $35. You could participate in prices up to $53.40 for Cal 21. Now, I just want to give you an idea of where these costless collars are right now, but you can see that prices have risen enough where there's some opportunities to be self-exposed to higher prices while protecting yourselves. Now, these prices are old as soon as they're quoted. Like I said, these are from yesterday around close. But it gives you an idea of the opportunity that the recent days have given you. And it requires something of you, though, to be able to achieve it. You got to know your price targets, have to be ready to execute, and having someone like you just side to watch for the opportunities. So, of course, it's not just oil. Our clients hedge all of the above, and there's some really interesting things happen in interest rates right now that allow you to lock in some low rates, but that's for another time. So if you need more details about these, send me a note. We're also having a webinar on Thursday that invitation to you. So with that, EnerCom, thank you very much for having us. We're thrilled to participate, and now I will turn it back to Jeff with Haynes Boone.
Thanks. And actually, I skipped the order a little bit. We will go now to Aaron Vanderford from EnerCom. So Liz, if you could skip back to his slide. There we go. Take it away, Aaron.
Hey, thanks, Jeff, and Matt. Thank you. I like the new addition of the pen there. I think it's something we got to keep. I want to say thank you first off to Jeff for that introduction, and certainly for their support of EnerCom and our conference. And we're excited to be able to bring this edition of the Energy Tracker to our audience as well. If you're a loyal Energy Tracker listener and would like to partake in the conference as well, on the slide at the bottom of the slide here, use registration code TOGC for the Oil and Gas Conference 25 and register and get a little bit more content throughout the day. I wanted to take a couple minutes and cover oilfield service and oilfield service technology as one of the trends that we're seeing. And so in this COVID-19 era of companies and employees working from home and more remote, we're certainly more reliant upon energy or upon technology. And one of the things that's actually happening as a result, I think E&P companies are getting a little bit more comfortable with the adoption and particularly with the cloud. And so we've seen a number of presentations already this week, but also some other conversations that we've been having with our clients, that technology is certainly one of those things that oilfield service is embracing, and we'll talk a little bit more about that. In 2015, there was a little bit of a shift for E&P companies to be disruptors or disintermediate the service sector and look a little bit more like logistics companies. And so they certainly found some savings in that, but E&P companies weren't naturally prepared to be a full service logistics company, particularly for the small and mid cap operators. And so what we're seeing now as we enter, this downturn where we're looking to be leaner and meaner, it's particularly hard. And so there's a little bit of a shift back towards the oilfield service company and the oilfield service company of tomorrow being a little bit more aligned with technology. And so we've certainly seen the Microsofts of the world partnering with large oilfield service companies. And even this morning, Halliburton put out a release talking about that they had been awarded a contract for digital transformation from the national oil company in Thailand. And so as companies, oilfield service companies look a little bit more like tech companies, we also have to think about how they're trading. And so tech companies, obviously we've seen the rise of their valuations, trades at a premium to dumb iron. And certainly there's a push for oilfield service companies to have a little bit more of this reoccurring revenue and technology associated with it. And so we'll see over the next little bit if oilfield service company multiples, as there's more adoption of technology and more partnerships with true tech companies, can see a result in uplift in multiple. And we'll see if that's longer term. Another plug for our conference this afternoon, I sit down with David Anderson, oilfield service analyst with Barclays, to talk a little bit more on this oil service issue, and we'll explore that. So with that, I hope everyone's able to join us. Jeff, really appreciate Haynes and Boone's support, and Matt, appreciate all of our opportunities to do this weekly call with each other. And with that, I'll turn it back over to Jeff with Haynes and Boone.
Thanks, Aaron. And thanks again for having us. And we'll shift now to the Haynes and Boone portion. And just a reminder, this call will go a little bit longer. It'll go till 9:45. And we may even extend it a little bit, but the EnerCom conference will resume with Earthstone presenting at 9:45. So you're welcome to switch back to Earthstone or stay with us. but we're going to get into a little detail here about what's going on out there. So first, a word about our Bankruptcy Reporter, if you could go to the next slide. Haynes & Boone has a lot of energy reports that we publish on our website in collaboration with our clients. We investigate the industry and put out a lot of interesting material. And so this is where it is on our website. If you just go to haynesboone.com, scroll to the bottom, click on Energy Reports and Surveys. If you go to the next slide, you'll see what you get. These are our periodic surveys. We do a borrowing-based redetermination survey. Our banking clients and producers clients give us their outlook on what borrowing bases are going to look like coming down the pike. And then we get the Energy Bank Price Deck Survey, which is where banks give us their price decks, and we publish them on an anonymous basis. And then we publish the roundup periodically, which is articles about the energy industry. And then the last three are the bankruptcy reports, which are of particular focus these days, in particular the oil patch bankruptcy monitor, which is what I will talk about a little bit here, because we just published our latest one covering the July filings. So if you can go to the next slide. This is just one of the slides. If you actually go to the presentation, it has numerous ways of looking at these bankruptcies, and I would invite you to do that on our website. But I just picked out this slide. It's just kind of showing the basics of what's going on. Haynes & Boone has monitored all of the North American oil and gas bankruptcies since 2015. We have lawyers who pull the filings, review it, get the data, and put it into these filings. Special thanks to Vicki Marsh, by the way, who's the lawyer who currently does that. And after the initial wave in the first 2 years, there were about 100 bankruptcy filings, but then they decreased by half in 2017 and 2018. And then in the second half of 2019, we saw bankruptcy filings pick up. And then since January this year, they have substantially picked up pace, especially with the dramatic decrease in prices this spring has pushed a lot of these companies over into to decide to file bankruptcy. So in July, we had 9 producers file, which combined with the rest of the filings this year is a 66% increase over last year. And we expect that pace to continue and, in fact, increase for the remainder of the year. Over the 5-year period, as of July 31st, 240 producers have filed for bankruptcy, involving more than $171 billion of debt, with $49 billion so far in 2020. And you can see here from the chart, kind of the spike up, that the number of filings is not up dramatically, but the amount of debt involved is. Especially in July, there's some large filings that increase the total debt figures here. So anyway, I won't dwell on our report. You're welcome to come to the website and see the rest of the report. But for now, I'll turn it over to Eli and Charlie for some inside baseball on what's going on with all the E&P companies in bankruptcy.
Yeah, thank you, Jeff. This is Eli Columbus. So one thing that we're seeing, we see trouble at the 1L corral. I guess sticking with our theme, it could also be trouble brewing in the bullpen. But one dynamic that we're seeing, which is driving some behavior in workouts and bankruptcy cases right now, which we didn't see in the 2016-17 timeframe, is that the first lien debt recovery and value is significantly impaired in a lot of these cases, where, you know, back in 2017, those cases were largely about balance sheet restructurings where the first lien debt was, for the most part, left unimpaired or reinstated. Now we're seeing significant impairment and charge off at the value at the 1L. And this is causing tension within the first lien lender groups, given where value and recovery is in the market. Options are limited. You know, we're seeing cases that are just selling assets, you know, sales of collateral, and we're seeing that the results are not good for the first lien lenders, and there are significant losses and charge-offs at the first lien level. There's also cases where you're converting most of the first lien debt to equity, and then there's some cases where there's a combination of, you know, a reduced first lien take back debt and then a partial debt conversion to equity. And you know, it's common for these lender groups to include a diverse group of banks, you know, including large domestic national banks, foreign banks, regional banks. Sometimes we're seeing in these groups banks with limited history and experience in energy finance. And then you include in some of these bank groups non-bank distressed purchasers of RBL debt, and now you're having to deal with a diverse group with different attitudes and approaches to how to deal with the credit. So if we move to the next slide, I'll let Charlie step up to the plate to talk about how this is impacting strategies and approaches.
Sure, thanks, Eli, and good morning. This is Charlie. One of the more interesting things that Eli and I have confronted in a number of these bankruptcies, and whether or not we're representing the first lien RBL lenders or the borrower or other parties, perhaps a purchaser, is I think our initial approach for a number of years is that we were looking at that first lien RBL lender group to be a single-minded monolith, that everyone thought, gee, they all have common interest goals and a playbook for how they want to proceed. What Eli and I are seeing consistently now is rather than a single-minded monolith, it appears to be more like a cat rodeo with all sorts of folks going in different directions and having different goals in mind. Let's go to the next slide. And it really comes down to the way folks are looking at it. Different syndicate members are looking at it when they enter into bankruptcy. In many of the cases, we're seeing there's insufficient liquidity to live through the Chapter 11, and the borrower is going to need to get a DIP loan. Traditionally, those first lien RBL lenders would all sign on and become DIP lenders. We are finding increasingly that not all the first lien lenders want to be DIP lenders. One, because they think that they may be, they just don't want to do it, or especially with some of the foreign bank lenders, we are finding that some of those foreign bank lenders cannot get approval from Paris or the Netherlands or Tokyo to participate in a DIP loan for an E&P company in the U.S. And that may be because they've just decided they're not going to extend any additional capital into the E&P industry for policy reasons. That creates some real interesting dynamics, because not only are they not willing to participate in the DIP, being funding new money into the case, they're also refusing or declining to subordinate the pre-petition first lien debt to the new money DIP. And the credit agreements in many of these instances may require larger consents than just the agent signing off on it. Can be majority lenders, and in some instances, it can be 100% of the lenders to subordinate a lien. So we're seeing some pretty exotic ways to get around that and provide parties with an opportunity to be treated like a DIP lender, but not actually be a DIP lender, or agents trying to, for lack of a better term, oppress the interests of the first lien lenders who refuse or decline to participate. So we're going to see some continuing tension with respect to consents, requirements, and voting with respect to how to get some of these companies easily into a Chapter 11 if they need DIP financing. Eli, I'll turn it back to you.
Yeah, so if we move to the next slide, you can imagine now, the exit strategy from Chapter 11 people's approach can vary significantly, especially given the diverse group of banks that we're seeing. We see some bank groups with 10 or 12 lenders that are all over the map in terms of size, approach, nature of their institution. And some we're seeing within the same, you can have all of these mindsets within the same lender group. Some lenders like the idea in the current market of taking control of the assets through an equity position and then holding until the market improves. Some first lien lenders are hesitant to hold equity, especially a majority or controlling stake, and we're seeing that also, that concern being raised also from foreign banks and some other banks. And then there's some first lien lenders that prefer to just, take their losses now, rip off the Band-Aid, and, let's do a sale process and move on. And then there's some first lien lenders that are more willing to explore and discuss a creative and structured alternative. The problem, again, arises in trying to reach a consensus on a strategy when you have all these different diverse group of holders with these different approaches or preferences and how to deal with the case. And again, we're in a situation in the market where you're running out of time and you're running out of money pretty quickly. So sometimes we're seeing a lot of these deals where a restructuring consensus is not reached, where just the easy fallback is that people understand is sell the collateral. But we're also seeing that that's resulting, a sale process is resulting in certainly some very discounted value to the first lien lenders. So, what we're seeing is the administrative agents on first lien debt, they're not likely entering the negotiations with the borrowers or the junior debt holders with a clear strategy and consensus among the lender group at the very start. I think that the strategy for the administrative agent is developing as they discuss with their steering group and other banks in the lender group, which way do we go with this credit? And again, at the same time, there's a lack of new capital available and money's running out and time's running short. So it just makes for a very, very challenging market right now.
One other aspect,
yeah,
let's stay on that last slide for a moment. Buddy Clark just sent Eli and I a question about, okay, who's paying for this cat rodeo? And interestingly enough, it kind of depends on the credit agreement, which may have been negotiated years ago. And typically in these credit agreements, the borrower is responsible for paying the post default for the professional fees of sometimes just the administrator's agent, but typical in many of these credit agreements is the borrower responsible for payment of the professional fees of each syndicate member. And you can expect that if each syndicate member professional fees are to be paid by the borrower, that folks become a little bit more emboldened when they're not paying for the fight out of their own pockets, but are having the borrower pay for those fees. So another interesting aspect of how these fights get financed, and which makes it even tougher sometimes for any of us involved in these negotiations. But Eli, back to you.
Yeah, thank you. So if we move to the next slide, the next topic we want to talk about involves litigation and challenges to, all kinds of oil and gas agreements. What's gotten a lot of attention in recent years has been the litigation over gathering agreements and whether or not they're executory contracts or covenants that run with the land, whether they can be rejected in bankruptcy or whether they're a burden on the assets going forward. But we're now seeing, again, this is the nature of being in a more distressed situation where there's impairment at several levels within the capital structure. We're seeing now litigation and challenges beyond just midstream agreements. And I guess, Charlie, I'll let you explain kind of this attack on the industry in terms of agreements and structures.
Sure. And what we are seeing is for probably in the 2016, 2017 era of E&P bankruptcies is most of those bankruptcies, with one exception I'll mention in a moment, which the restructuring that we saw were balance sheet restructurings, debt to equity conversions, little done on the operational side in terms of perhaps saving money with respect to normal operations. And now we're seeing something a little bit more interesting, but this was inspired by one of the early filers, Sabine, which had the midstream issue and the ability to assume or reject midstream contracts, and we'll talk about that in a little bit more. But Sabine was kind of an outlier with respect to, gee, were there really any litigation going on in these bankruptcies that was going to change the internal dynamics? What we are seeing now, and it's popping up a lot, is in many of the cases, we're seeing that the attack on the midstream agreements. And also we're seeing instances in which there are challenges to net profit interests and conveyances with respect to that, overrides and joint development agreements. It is from what we can observe, and we're involved in many of these cases, it is really a creative parties determining that, well, gee, these assets that I thought I had a lien on, and do have a lien on, would be more valuable if they could be unburdened from these obligations that the borrower placed upon these properties long ago. And despite the fact that many of these parties entered into lending transactions subject to those burdens, they are now figuring out ways to attack them. And why don't you talk about some of that, Eli?
Yeah, so if we move to the next slide, as Charlie mentioned, we're involved in many of the cases where the nature or treatment of these types of agreements or interests are being litigated or challenged. And again, the issue that's gotten a lot of attention is whether a gathering agreement is an executory contract that's subject to rejection, or whether it's a covenant that runs with the land and can't be rejected. We're now also seeing other theories spring up of challenging these types of agreements, including avoidance theories like preference. Can a certain type of agreement be avoided, those obligations be voided as a preference or fraudulent transfer, depending on the nature and timing of what gave rise to the agreement. And then on the next slide, we're also seeing the expansion of these arguments and challenges into other types of agreement. And the Sanchez and Gavilan bankruptcy cases are an example of that. This is, those cases involve a complex set of agreements where the assets were purchased through a unique purchase and sale agreement and a joint development agreement that also included various gathering and processing agreements, marketing agreements, agency agreements. And there's a disagreement among the two bankruptcy estates. There's the Sanchez bankruptcy estate and the Gavilan bankruptcy estate. The Sanchez debtors are seeking to reject certain of these agreements and assume others. And then Occidental, who's got a stake in the Gavilan estate, and Gavilan are on the other side of the dispute, and they're arguing that these agreements constitute an integrated, non-severable contract that's not subject to rejection. So again, you're seeing now this whole issue of, can certain things be rejected in bankruptcy, or are they burdens that can continue on the assets, is now creeping into not just the gathering agreements, but purchase agreements, joint development agreements, and the like. So we're also, as Charlie mentioned, there's certain other interests and financing arrangements that are being challenged, NPIs, overrides, on various theories, including whether they're financing arrangements that would just give rise to claims instead of conveyances of real property or burdens on property that would attach and move forward. So again, very interesting dynamic, the broadening of these, and as you might expect, the deeper, you know, the insolvency, the more impairment of value, the more that's at stake for people to fight over for recovery. And on the last slide, you'll see, you know, what's interesting.
Before we get, hey, Eli,
I'm sorry. Yeah, go ahead.
Get to that last slide. An interesting dynamic that I think is playing out here with respect to this litigation, and I'm not suggesting that there needs to be a legislative solution with respect to how to solve this executory contract and conveyancing issue, dedication issue, is in the 80s when there was a lot of litigation over the viability of farm out agreements. And there was concern within the industry of how this was going to sort itself out. Senator Benson, who was the senior senator from Texas at the time, presented legislation to amend the bankruptcy code to protect farm outs and production payments, an industry standard that had existed for a long time, but was subject to attack in some bankruptcies. So to straighten that out, Senator Benson proposed and passed legislation to amend the bankruptcy code to protect farm outs. It'll be interesting to see whether or not there's enough strength in Congress to come up with a common amendment to the bankruptcy code to address this increasing executory contract versus conveyance of an interest in real property. And it may be something that folks want to consider, although I'm not sure everyone would be completely aligned on that. The reason that you may want to come up with some national standard is because of the next slide, the venue issues that and the diversity of opinions that Eli's going to talk about. Eli? Jeff, have we lost Eli?
We may have.
Okay. All
yeah.
right.
So, Charlie, would you care to talk about venue and geography issues?
Yeah. I can clean this up. It goes to venue and geography. The reason that this may be meaningful, or one of the reasons it is meaningful, is these three examples that we're going to use. Sabine, Texas-based operator, filed bankruptcy in New York. New York Bankruptcy Court asked to interpret Texas law relative to dedication issues and whether or not there was a conveyance of the real property as opposed to an executory contract. Alta Mesa, more recent filing in Texas, and the contracts that were subject to rejection examined by the Texas Bankruptcy Court were interpreting Oklahoma law because the gas gathering agreements in that instance were Oklahoma. Now we have Extraction, more recent filer this year, filed in June in Delaware. Extraction's assets are in the Denver Basin, and the bankruptcy court in Delaware is being asked to interpret Colorado law. All of this could create just going back to the cat rodeo, a lot of dissension and but a lot of pushing, pulling of hundreds of millions of dollars across the table as folks fight for their own recovery. So with Jeff, I'll turn that, with that, Jeff, I'll turn it back to you. Thanks.
Thanks, Charlie. And I'd like to ask a follow-up question. It is 9:45, so the EnerCom attendees who wanted to watch Earthstone can feel free to switch over. But those of you who'd like to continue, I will ask my question. Charlie, when you were talking about efforts to kind of blow up some of these contracts, I kind of get the impression that they feel like they have to, because some of these things have gotten so bad that these midstream contracts with minimum volume commitments may impede the reorganization of the company. The obligations are so big. What happens at that point if it does encumber the assets? Do they turn to that midstream company as if they were a creditor because they've kind of become the fulcrum debt at that point, or how would that work?
Generally, what we've seen is, in the first instance, the challenge to the midstream agreement coming through way of a motion to reject or an adversary proceeding seeking a determination that the midstream agreement is subject to rejection. It's often used as a negotiating technique to attempt to reduce the rates on the midstream contracts to negotiate a better deal. Depending on the case, and there was one up in the Bakken a couple of years ago in which the parties were, the debtor decided to try and reject the midstream agreement, but really didn't have a viable alternative for transporting its oil. But in what seemed to be a little bit of active desperation, they started trucking their oil out, which was not a very efficient solution, but it was done in an effort to show the midstream company that, I don't have to have you. I can just truck it out, maybe not economically, but so it often comes up in the context of negotiations. In another case, it was in Delaware, there was a sale process through 363 that the buyer said, I will pay X dollars for the assets if you will institute a proceeding to reject the executory contracts for the midstream, or if you don't reject those midstream agreements, I will pay X minus Y for the assets. Over time, negotiations went forward, and there was a reduction in the purchase price. So it's all about the economics and gaining leverage to perhaps improve the toll on the midstream contracts, or ultimately potentially reducing the purchase price. In the Sanchez bankruptcy, the plan was confirmed, but the ability to reject executory contracts was reserved for further litigation, and that litigation is ongoing now post confirmation of the Sanchez plan and going effective. So all about the economics, Jeff.
Yeah, this is Eli. I hope I'm back on. Let me add that this will drive some commercial resolution, you would think, but it does, a lot of bids or plans or, agreements are conditioned on whether or not the agreement in question is going to be restructured as well. And in a lot of cases, a commercial solution is ultimately reached because, even for the counterparty, they're dealing with now an insolvent counterparty on their end. So even if the agreement were not to be rejected, the question is, can I rely on an insolvent estate or counterparty to comply or perform? And then how's that going to affect who the new counterparty or reorganized company or buyer may be? So it does drive some commercial resolutions, and a lot of these cases end up getting settled. but it seems like there's more and more being challenged now given the level of distress we're seeing. But ultimately, it may take a few rounds of discovery or motion, and then you ultimately get to a commercial resolution. But and Charlie, on your point of will there be a legislative solution for some of this, that would be interesting to see, you know, which lobby wins out. You know, there would be a different viewpoint from the EMP folks versus the midstream folks on how the bankruptcy code should treat and deal with certain types of agreements and covenants. But you're right, there's been specific amendments to deal with farm out agreements and production payments in the bankruptcy code. So the question is, will that expand to gathering agreements, midstream agreements, NPIs and the like? But interesting to see if anything develops there.
Thanks, Eli. Thanks, Charlie. These are important issues, and they're not just issues that affect the companies in bankruptcy. They cast a specter over the whole industry as these commercial relationships are affected. You know, all oil and gas companies have to kind of reconsider their contracts and their relationships in light of the developing law on these issues, which I would expect to develop more and more as more filings come down the pike later this summer and the fall. So we will return to Charlie and Eli and others for updates as things develop. We're past time now, so I appreciate everyone bearing with us. And thanks again to EnerCom for allowing us to crash their party and be part of their conference, and would encourage everybody to join us next Tuesday, August 25th, where we will get into these issues again. Thanks.
Thank you.